Hello, thank you for joining us for the webinar titled Common Challenges in Private Equity, Hedge Fund, and Venture Fund Valuations under GAAP. We're going to give it about another 30 seconds to let people join, make sure we get as many attendees as possible, and then we'll get underway. Thank you. All right, we're going to go ahead and get started on today's webinar here. Thanks again for joining us. I'm going to go over just a few housekeeping items so we're all on the same page here. Everybody is on mute, all the participants right now. If you do have a question, if you look in your webinar dashboard, there is an area to type those questions. We will see those during the webinar. If it makes sense for us to answer those during, right as they come in, we certainly will. We'll also try to reserve a little bit of time at the end to answer those questions. If we do not get all the answers or the questions answered in time before our 1 o'clock Mountain Time ends, we will get a report afterwards with all the questions and who answered those along with their contact information. So we will follow up with you directly. Also want to let you know that a recording of today's webinar along with a slide deck will be emailed to everybody who registered and participated today, so please look for that in the next day or two. For those of you who are looking to qualify for CPE today, in order to qualify, you do need to answer all 3 poll questions that will be launched throughout the course of the webinar. We'll give you ample time to answer those. You'll see those pop up on your screen. You don't have to answer those correctly, just as long as you give an answer. That's all you need. And a survey will also appear at the end of the webinar once we close out, so you do have an opportunity to give us some feedback on today's content. For those who do qualify for CPE, the CPE certificates of completion will be emailed out to you directly. Give us a few days. It does take some time for us to pull those together. Other than that, we will go ahead and get started. I'll turn it over to Steve Vlasic, who is going to introduce our presenters today.
Hi, everyone. My name is Steve Vlasic, and I'm a partner here at Richey May. We're a CPA firm that specializes in alternative investments. And I just wanted to thank all of our clients and friends in the industry for joining us on this webinar, Common Challenges in Private Equity, Hedge Funds, and Venture Capital Valuations under GAAP. And the reason why Richey May, Simon Compliance, and Intrinsic Valuation decided to host this webinar is because when we talk with our clients, outside of raising capital, valuation is the next most common question we receive. So we wanted to bring some value to the industry and make things a little easier for everyone. We hope you find this webinar beneficial. And now I'll hand this over to Josh Cashman, the Managing Partner at Intrinsic Valuation.
Thank you so much, Steve. Thanks, gang, for having us. We're delighted to be here at the Richey May offices and talking about valuation issues that crop up for private equity, hedge funds, and venture capital funds. This is the second time we've done this presentation, and I'm especially thrilled because we have Lindsay Simon joining us today. So we'll have the opportunity to talk about some real world experience in terms of where valuation issues might crop up or how to prepare for valuation issues that could crop up for our clients. So I think Lindsay will add a whole lot of substance to our conversation today, and we're looking forward to having that. So as Steve mentioned, we're Intrinsic Valuation. We perform valuations for most funds, for hedge funds, private equity funds, venture capital funds, for tax, financial reporting. And we'll kick this presentation off. As I said, my name is Josh Cashman. I'm here with my colleague, Russ Williams, who really specializes in this area. And then, as I said, we're delighted to have Lindsay Simon along with us to talk about compliance issues as they crop up. So we talked a little bit about who we are. There's the what and the why. Valuation, for most of you on the line, understand why that's relevant. And we'll talk a little bit more about the parties involved, and then talk a little bit more about why. And Lindsay will help us there in discussing why these issues come up. We'll talk about valuation best practices. and then we'll go through some examples and common challenges that come up in the valuation context. And again, it's a pleasure to have Lindsay here to talk through some of these issues and some real-world cases that have cropped up where valuation has been a key issue. So I'll kick this off then. We've kind of gotten through the introduction. I'll kick this off to Russ to continue talking about who we serve and why we serve them.
Yeah, thanks, Josh, and thanks, Richey May, for having us today. I just wanted to introduce the presentation by really seeing who we're focusing on today. As the title indicates, the primary audience is hedge fund, private equity funds, and venture capital funds. However, the kind of lessons learned from this webinar may also overlap with operating companies and limited partners. So that's really our who for today's presentation. And next, we're going to move on to our first poll question, just to get a lay of the land of the audience. And I think Rachel's going to click this on now. Okay, thank you all for the responses there. We're going to move just on to the what. The what here is really, as it's bolded here, is really level 3 assets. That's our primary focus of today's conversation. Level 1 assets present limited challenges from the valuation perspective. These are assets that are regularly traded or actively traded in active markets. And are fairly, straightforward from a valuation standpoint. Level 2 assets as well are assets with similar securities in similar markets, and these present also, limited challenges from a valuation standpoint.
And if I may, Russ, like this, I often think of this slide as being sort of a funnel, where the range of possible outcomes, or a pyramid, the range of possible outcomes is very narrow within level 1 assets. Those are generally publicly traded companies. The range of potential outcomes in value is a little bit wider when you're looking at level 2 assets. A lot of times that's like PP&E, fixed assets, things where there is a ready market, but not necessarily for the asset at hand. And then level 3 assets is where the range in potential value is much broader, intangible assets generally.
Yep, so as you work down that funnel image, it's really the bottom of the funnel being level 3 assets with a high range of uncertainty. And that is where Intrinsic focuses all of its time. And these are really for private operating companies or thinly traded public companies, private placement credit instruments, and as it says here, private derivatives without an active market. And finally, the third piece of our introduction, the why. And I think this is a very important topic from a limited partner perspective, because over the past few years we've really seen an increased scrutiny on funds and their valuations, and really from the pure limited partner perspective, that draws into having them have a level of trust and transparency with the funds, for their external reporting to their own investors, in addition to allocating assets. So the SEC has followed in suit, with the demands from limited partners, and increased scrutiny on these level 3 assets and level 2 assets as well in the last few years. We're going to cover a few cases today from the SEC where they come down on investment managers for misreporting their level 3 and level 2 assets. And similarly, from a audit standpoint, and I know Richey May sees this quite a bit, that there is a increased level of scrutiny from the PCAOB on these level 3 assets. And as we've mentioned here, there are several other parties that can come into play, but the LPs, SEC, and auditors are really the main drivers of these assets being scrutinized.
And again, that's why we're fortunate to have Lindsay on board with us to talk a little bit more. I mean, from the SEC or audit standpoint or other regulator standpoint, so much of this comes from regulatory perspective. And to have Lindsay on board with us to talk a little bit about regulation or what she anticipates is hugely valuable. And I'm sure everyone on the line can understand the pressure that limited partners place, having become more intelligent and more savvy in terms of what to expect in terms of reporting.
So we're now going to kick it over to Lindsay to finish up the introduction on a specific on the SEC front.
Okay. Well, thanks, you guys. You've been very kind, and I'm happy to be on this call with everyone. And thanks to Richey May for including me, and Intrinsic for all the work that you put into this. I wish that I could say I had definite answers about exactly what everyone should do. I have some ideas, but like most things with the SEC, there is not often very clear guidance. We get instructions from cases, from deficiency letters, and from speeches that the SEC gives. What makes the most sense is that hedge funds are the ones that would be the most concerned about how valuations, I guess the valuations themselves and how they're carried out and the actual NAV of a valuation, because as most people know, hedge funds are taking a performance fee and a management fee based on that NAV. For private equity firms, it's a little bit different because there's a management fee that's just based on committed capital or invested capital, and there's generally not any sort of valuation derived performance fee figures. So the worry generally would be from a private equity perspective that you would be concerned when you're going to market, for example, in your fundraising, that maybe you've inflated your valuations of your portfolio companies or your fund valuations. Really, it seems that it would make most sense when there isn't a tie in some way from the valuation to a fee increase by the manager, that would be the concern. And as we'll see later when we talk a little bit later about the cases that the SEC's brought in this area, that is what happened. There was an increase in fees to the manager based on an improper valuation. So the SEC has been starting, though, there are a couple of areas where they've been starting to be more vocal about how they'd like private fund managers to act, but there hasn't been a specific case on level 3 assets that I've seen that's given direction. So the kinds of guidance and concerns that private equity and venture firms would have, to me, would be making sure that you have very detailed policies and procedures about valuation, that you follow those policies and procedures, and that if you tie your compensation in any way to a valuation of either the fund or the portfolio companies, that you're much more careful about how you value your investments and consider bringing in a third-party evaluation expert to do that for you. And then just the idea of your performance returns, especially during fundraising, you don't want to see an uptick in that number just to try to make your fund seem more valuable to new investors coming in for the next fund.
That is interesting stuff. So a lot of that has to do with self-dealing, or the regulating against the prospect of self-dealing.
In terms of the performance fees?
Performance fees and the capital raising issues, and in other words, the timing and so on.
Oh, right. So exactly. So I could definitely see a situation, there hasn't been one yet, but I could definitely see a situation where the SEC would deem it very misleading if you were to artificially increase your valuations before you go to market to make it look as if you have a potential for better returns for a new crop of investors or even existing investors, and then those who are re-upping.
Right, that's a great point.
So as I mentioned, those of us who are looking for answers, we look wherever we can. And so one of the speeches, which is, I'm not sure exactly how relevant this is now, but it's the only speech that's been publicly made about valuations. It's from former Chairman Mary Jo White, who everyone might know is a lot more aggressive of an enforcement head than her previous chairs. And she gave one speech in 2016, which I thought made it interestingly clear that valuations are not just about hedge funds and publicly traded securities, because in this speech here, this one quote from the speech, she talks about funds acquiring portfolio investments that are difficult to value, and they're being complex, not trading often, and that also that the pricing of the portfolio holdings and the NAV calculations be carefully considered. So to me, reading between the lines, I thought that the portfolio holdings here could be referring to portfolio investments from private equity or venture firms, and that NAV would be more akin to a level 1 or 2 asset that are easier to value and that are in the hedge fund context. The last sentence I thought was pretty strong, where she says, I, along with your investors, expect that you will get it right. So when I saw the transcript of the speech, it made me think that there was going to be a little bit more focus during examinations on valuations. And I think that we'll be able to see as we get further into this program that there actually has been a little bit more too.
It is interesting, though, Lindsay, that you kind of point to what appears to be kind of, I mean, clearly based on your introduction to this slide, that you're looking for any guidance wherever you can find it. And this guidance doesn't necessarily express a mandate for valuation or for an approach to valuation or for even independent valuation. It just seems like a loose sort of guidance principle. But do you see that as sort of being the spirit of where the SEC is headed?
So, Josh, that's like welcome to my world. So we have to look through tea leaves. It's very hard. It would be so much more helpful if the SEC would come out and say, we want you to do A, B, and C. And unfortunately, they don't. So all of us try to guess what they want us to do. And I think, you know, it's probably hard for people in your position and Richey May's position also, because we're trying to advise the clients in the best way possible. And we don't always know exactly what the commission's looking for.
Right. Thank you.
So we're going to talk now about some best practices for your valuation policy from a compliance perspective. And there's also, I think Richey May might have some things to add to this too, in terms of what they think of as the best practices. So I find it very, very important to have a customized valuation policy that is not just off the shelf from your law firm or one that you've gotten from some of your colleagues. In that policy, it's important to list out the standard under which you value your portfolio holdings. So, you know, private equity firms are usually valuing an ASC topic 820. Hedge funds have obviously a different one. Whichever one you use, you should make sure to state. I would also be mindful. I had a client that had not updated their valuation policy, and they had listed FASB 157, which is not obviously being used anymore, and they had not replaced it with the new ASC 820. So I would be mindful about looking back at your existing policy and seeing that you have that in there. I think it's also important, when Russ started out, we were talking about level 1, 2, and 3 assets. I have each of my valuation policies list out just a summary of those 3, and then stating which type of level assets the advisor has under management. And then another important input for your valuation policy would be to describe the type of investments that you have. And also, this might not just be the ones that you have, but that you could contemplate having. So if you're a private equity or a venture firm and you have just private companies, that's great, but you should consider whether you might have any that could go public, whether you have PIK dividends, warrants, if you have any preferreds, convertibles, even escrows. Sometimes have valuation questions, so I would try to consider the laundry list of any types of holdings that you have, and then ones that you think you might have too. We can go to the next slide, please.
We got it. Thank you.
Okay, thanks. So one of the things to keep in mind when you're drafting your policy is to also have in the inputs for level 3 assets. So obviously, there are a lot of considerations that go into place, and this is where Intrinsic would be able to help with drafting a policy too, and then considering what you actually would look at in arriving at evaluation. Some of the ones that I've seen that are more common, and Josh or Russ, feel free to jump in, but discounted cash flow analysis, publicly traded comps, precedent transaction analyses, one-time or recurring changes events. If you have any idea about future changes, material changes at the company that are bona fide, that are not just, I guess, hypothetical. And then if there's been a third-party indication of interest for a sale, but bona fide, not just, you know, there's a bunch of people that are talking, I guess. Whether there's been an acquisition process, if you have ideas about financing transactions. So basically anything that also the internal deal team has about the portfolio company's management capabilities, market conditions, sales trends. Those are all good inputs for considering how you would value your level 3 assets.
Excellent. Well, boy, Lindsay, you just took our presentation away. Thank you, but you're absolutely right. All of the points you bring up are absolutely right on point.
Okay. Is there anything else that you can think of that might be helpful to add? I tried to do the laundry list of.
Well, I would be interested in actually having Travis Thompson here at Richey May. And Travis, we did this presentation last year as well, and Travis is a ringer auditor that handles all of these matters from the audit perspective. And so we talked a little bit about the valuation policy statement and how that applies, and you cross-referencing with both ASC 820 and the policy statement itself to ensure that there's consistency. What are your thoughts? I mean, at first kind of glance when we start talking about these issues.
Well, the level of detail that Lindsay has discussed is something that we definitely want to see in a valuation policy from all our funds, especially when we're doing a GAAP audit, which the vast majority of our clients need. The main thing we're going to look at is that the policy is applied consistently across the fund's portfolio, especially specific buckets of investments. So if you've got a specific type of investments, you're investing in preferred stock, for example, we want to make sure you're using the same methodology for all those investments that you hold. Another thing we see is we want to see at least annual valuations or revaluations. Oftentimes, funds may hold something at cost, and a couple of years down the road, they're still holding it at cost. In a case like that, we need to understand why cost is still a relevant price and get the support and third-party inputs for why cost is still appropriate.
Yeah, great. Thank you.
So some of the, I'm sorry, could you go back to the other, thanks, sorry. One of the other things to consider that I've also seen the SEC ask about during examinations, if it isn't in somebody's policy, is the procedures that the advisor follows. So for example, do you use a valuation committee, or do you use an investment committee, or do you just have the managing partners of the firm meet? What's your process? Do you meet on a quarterly basis, a semi-annual basis, an annual basis? Do you have deal team members come up with the inputs and then the CFO reviews it? Does the lead principal on each deal do it? Each firm has a different process that they follow. And then how you document that process and the inputs that go in is really important too. So I'm sure it's important. I'm sure that when Travis is out doing an audit, he needs to look at that too to verify that you followed your procedures. And then the SEC wants to know what documents you also retain as part of your procedures too. And so when you're putting something in writing like this in your policies, you should make sure that you're not cutting off more than you can chew, so that whatever you list that you do, that you actually are able to do every time and time again. But examples would be like board books or things that come from a portfolio company, financials from portfolio companies, those types of documents. If you get them every time and time again, and you rely on them, that I think it would be important to put that in your policy too. And then one other.
We'll definitely look at that as auditors and need that support as well.
So those are internal controls prior to audit.
Right.
So I also think it's important, I don't know, Richey May, if you guys have anything Travis, if you have anything to add on this, but just deciding what constitutes a permanent write-off or write-down, I think should also be included in your valuation policy too. It should not be left to discretion. There should be some written guidelines about it.
Okay. Yeah, I would definitely agree. We need to see something, we're going to look at a permanent write-off the same way we look at evaluation. There needs to be support for the reason and something we can look at, third-party data, a reason we can support and rely on that.
So I sort of like a succinct summary of this is my opinion, so this may not be everyone else's opinion and who practices my space, but what I think the SEC is looking for are strong policies and procedures, following those procedures, having some detail in your limited partnership agreement and PPM regarding those policies and procedures, then making sure, I think Travis, you alluded to this before, making sure there's consistency among all of those documents. That if something has changed, the more likely scenario would be that your LPA or your PPM has been updated in your policies and procedures, in which case that's okay because you're not changing your PPM or your LPA unless you're a hedge fund, and not even that often. So I think you want to make sure that you have consistency, but noting that, of course, it's the PPM and LPA are not flexible documents to be changing. And then you also want to be careful when you're using a third-party valuation firm. There's two cases that we're going to summarize next, that that you're actually giving them the right inputs and that you're not just trying to have them rubber stamp something or not having them rubber stamp you, that you want to actually have some valuable conversations and input. And I would think that maybe Josh or Russ, you guys could speak to sort of the interaction that goes on there and what firms should be looking for in terms of the engagement level, keeping in mind that the last case that we were talking about was a gentleman who didn't use a third-party valuation firm in the right way. And then just one takeaway I would say, though, about these policies and procedures is if everyone had time as a follow-up or takeaway from this seminar, if they could just go back and take a look at those, look at your policies and procedures for the items that we discussed earlier, look to make sure that you're following them, take a look in your LPAs and PPMs to see what you have in there and see if you think that there's consistency too.
Okay, that's great. That's great. And we will touch on that as well, Lindsay. Thanks for pointing us in that direction in terms of maintaining valuation provider discretion and independence. Okay,
that'd be great. Thanks. So there are two cases that I found that seemed that they were somewhat relevant for this group and talk. Covenant Financial Services was just this spring an SEC administrative proceeding in front of an ALJ, which is an administrative law judge. And in this case, the hedge fund advisor had misstated the value of assets in 5 of their funds, which meant, because of that restatement, that the advisor actually received management fees well in excess of $400,000 than what the SEC thought they should have, and that they also incorrectly calculated redemptions that were coming from the funds too. The interesting thing is that Covenant did use a third-party pricing service for their valuations, and these were for municipal bonds. So what was interesting, and I've been trying to, there isn't anything completely that I found that was on point for level 3 assets, so I'm trying to read between the tea leaves, and these two cases are ones that we can hope can help us with that. But what the SEC found was that the third-party pricing service did not consider level 2 inputs into the models, which was, they thought, inconsistent with GAAP and fair value, that it shouldn't have just been level 1 inputs. And especially because the advisor sold some of the bonds at prices that were over 40% less than what the third-party valuation service valued them at. So the SEC found that that was inconsistent with both the governing documents and then the firm's valuation policy, but also with the financial statements. So it sort of brings all 3 of us on hosts, Richey May, Simon Compliance, and Intrinsic into the mix here. These were all 3 violations basically from each of our different areas.
Great point.
And the next slide, this was an interesting case. It got a little bit of more press because there was some backstory with Luminaire too and his relationship with the firm. But some of the backstory was that some of the personal relationship that he had sort of caused him maybe to make some bad choices when he was valuing investments. But he was a portfolio manager that had credit securities. And he was actually sentenced, so this was not an SEC administrative law judge. This was actually a criminal case. And he was just found guilty, I think, a couple weeks ago, and Luminaire is going to be serving 18 months in prison for this. So sort of a pretty, I think, marked difference between paying a penalty for Covenant and going to jail for Luminaire. So Luminaire and another portfolio manager used sham broker quotes to mismark the securities held by the credit funds that they were the portfolio managers for. The advisor that they worked for was called Visium Asset Management. The policy, though, the valuation policy, said that the credit funds were supposed to be valued by the accounting team or by anyone independent and be using sources like Bloomberg and Reuters, not by Luminaire and another portfolio manager who were actually the portfolio managers of those assets. So it would sort of be, Josh, I think you said something about self-dealing. It would sort of be another example of a self-dealing type of, action there. So what's amazing is that there was a lot of mismarking, I guess you could say, of the valuations in this case. The SEC was really specific, too, which also is an indication for all of us listening about their increased sophistication and understanding of how valuations work. In this case, the month-end valuations by the credit funds were inflated between 5 and 35%. NAV was inflated by as much as 7%. Month-end performance was overvalued. And then there was also this miscalculation of distressed assets as level 2 when they really should have been level 3. And all of this resulted in an overpayment by the investors of over almost $6 million in management and performance fees. So it's a very, very high number of fraud that went on here, and which seemed to be very intentional.
And based on some of our earlier conversations, Lindsay, where this is most likely to crop up is, as you say, where fees are based on NAV, and which is most likely the case in a hedge fund rather than in the case of private equity or in venture capital funds.
Definitely, but I think that there's also a takeaway too here between again, the second case of not following your policies and procedures.
Mm-hmm. Excellent. And, well, and just one more question, if I may, Lindsay, and we talked a little bit about this, but just this idea of the SEC, its mandate not being absolutely clear. And what that tells me is that, with a change in leadership, the mandate, or as resources might lift, and, assuming that the SEC is resource constrained, that at some point these issues might become more clear. In other words, they're pursuing these issues might become more clear. And if that were the case, how would that affect those days where perhaps the issues were not as clear under the SEC's watch? In other words, would there be a retroactive sort of scrutiny applied? I mean, do you ever think from that perspective that if things were to change, if the SEC were to suddenly make very clear their demand for independent appraisal or for specific valuation policies, that it might affect funds retroactively?
It generally doesn't. But to be honest, there's been a lot of areas that we've been waiting for guidance on. So completely unrelated to this topic, which maybe I shouldn't even bring up, but there's this whole idea of transaction fees. And there's been a lot of anecdotal speeches, and then one case in particular, and then a lot of lobbying in Washington, and nothing's happened. So there's been no guidance. But there was talk in that situation from people who were lobbying, that I know that were lobbying the SEC, that no, it would not be retroactive. You can't go back and then have advisors give back all this money. So I would hope that it wouldn't be retroactive. But I do think that so there's a big case that people talk about called Patriot Partners, and this very controversial founder named Lynn Tilton, and they are embroiled in a lot of litigation with the SEC. And one of the claims is about not following valuation policies and procedures, overvaluing by gross amounts, not having any valuation policies or even mention in the governing documents. And Patriot Partners is the one that is fighting the constitutionality of the SEC's administrative law tribunals. So the issues are being clouded by just the process itself, by saying that the process is unconstitutional. But in that case, which has not been decided yet, there is a very, very large claim about valuation. So, Josh, hopefully to your point, it doesn't happen as we would like it to be, that there is a risk alert issue, like for cybersecurity, or the way FINRA works, which is much more black and white, that they put out a new rule. I guess the best that I think I could probably hope for, all of us could hope for, would be that maybe the Patriot Partners case comes out with something that gives a little bit more guidance on how to proceed with level 3 asset valuations. But I do, reading between the lines, the SEC is pretty, I think if you look at the themes that we've discussed just already, and then you guys will then hammer on more, just being consistent and having disclosure, being transparent, being consistent, having disclosure is, what the SEC is looking for. And if you in good faith are able to do those items, then I think that you'll be in good shape.
Right, great.
And so at this point, I know we're going to move on to poll question number 2.
Well, thank you so much. We'll move on here. Russell, kick things off in terms of valuation best practices, specifically valuing companies and valuing assets held within portfolios.
Yep. Thanks, Josh. And so, like Josh mentioned, this is really the second half of our best practices section. And I just wanted to hit on three key points that we think about, really from an investment in a fund context. And the first one is model calibration. So this is really, calibrating your the value placed on assets to past valuations or past transactions, as well as the overall investment thesis or story. This is something that I'll be repeating kind of throughout the following sections. And the second concept we talk about a lot as well is triangulation of valuation methodologies. As Lindsay had mentioned, there's three primary approaches: the market approach with guideline transactions and public companies, the income approach and cost approach. And we'll talk about those briefly, but really triangulating those three approaches is very, very key. And then finally, one thing more at the fund level as opposed to the valuation firm is internal back testing. And this is really looking at your past assets and the values they've exited for, and applying those lessons learned, if you will, to current valuations.
So kind of harping on what Lindsay and Travis had said in terms of applying consistent manners across the board for consistent assets.
Yeah, I think the Covenant case was a good example of where you could loop in either calibration or back testing to say that they were seeing other assets selling for much less, while the current portfolio was being marked up at much higher values. So they weren't taking that new information into account. So that's really highlights really in my mind, calibration or a failure of calibration and back testing. So I'm just moving on to the third section here. We're just going to run through a valuation in a private equity context, and show some common challenges in the methodologies that we see. So again, this is a purely hypothetical example where we have a lead investor that is invested in an operating company, and a co-investor that has come in alongside of that lead investor into a preferred security. And just briefly, again, as I mentioned, the company was acquired in this example in mid-2015, and now we're at mid-2017 doing the valuation. And this is a company that's securely into the middle market with about $250 million of revenue, and does have positive and stable EBITDA margins, and has had reasonable revenue growth at around 13% in the last 2 years since acquisition. So it has expanded some EBITDA margins since the private equity firm took it over, and has performed fairly well. So that's the background. And by the way, this is the operating company is a medical staffing service provider. So briefly, I just wanted to show, I wanted to weave into this example a complex capital structure. So as you'll see here, the lead investor is invested in a participating preferred stock, and the minority or co-invest is sitting in pari passu with that security. So those two investor groups are on the same basis and same payout structure. And there's also a management team that will hold common stock. And just real quick to walk through this waterfall at a high level, the waterfall would first go to the preferred investment is step number one. Step number two would be to pay off accrued dividends on that preferred security, which is a very common private equity structure. And then third, there would be an allocation between preferred and common, since it is a participating preferred stock. And I did want to loop in one nuance here, and that's the concept that first step, the payoff of the investment, would have an early exit provision. So the private equity firm will get, and the co-invest in the preferred stock will get 1.5 times their capital back in that first allocation if the exit happens in the first 4 years of the holding period. So as you'll see here, that'll be exit events prior to 2019. So again, that's just a little background on the company and the capitalization structure.
Well, Russ, real quick, on that slide, I see that you had highlighted the co-investor, but ostensibly their economic rights are no different than the lead investor. Could you just clarify why it is we're focused here on the co-investor?
Yep, and we've seen many cases come up where that lead investor may take the valuation on internally. As we talked about that there's headwinds there with a self-dealing concept, but the challenge we usually see is whether it be a private equity fund or an RIA going into a co-invest situation, they will want to many times bring in a third party to value their interest, independent of the private equity fund, just per their investment policy statement and internal guidance.
Okay.
So that's why I've highlighted this. The subject interest really is that the shares of co-invest. And just briefly, you don't have to read too far into this slide, but we just wanted to highlight or give you a snapshot of where the financials are at. So as you can see, revenue has grown since the acquisition in 2015. The company is producing positive EBITDA margins and free cash flow margins, which have grown relatively stably over that holding period. So now I think it's important to highlight from a valuation perspective, here at Intrinsic, we really think of valuing that preferred security, which co-invest owns in this case, in a two-step process. And that's really first getting to total equity value, and then allocating that total equity value to the securities at hand. And within each of those two approaches, there are three methodologies that we think about under getting to total equity value. That really comes down to the market, income, and cost approaches. And then we'll talk about our three approaches under the allocation of that equity value in a moment. I would like to highlight, just in the interest of time, and I think our audience on the phone, we won't spend a ton of detail on getting to total equity value. Rather, allocating that equity value will be our focus.
And Lindsay sort of nailed those three approaches already, and they're obviously commonly known, and the idea that there are these three different approaches, and at the end of the day, in order to arrive at equity value, we want to triangulate these three different approaches and have all of them make sense.
Yep. So just very briefly on this slide, the market-based approach with guideline public companies and guideline transactions really is looking at price indications and multiple indications in the market, applying revenue, EBITDA, and free cash flow multiples to the subject company. And you'll see there's definitely some challenges in this area and to be cognizant of, whether it be the size of the data set or the growth profile, the geography. There's definitely some attention that needs to be paid in those areas. So here we just want to show very briefly that in our example, we are looking at a transaction data set that does have our subject company in it, in addition to several transactions that happened in the space. And we've selected a multiple of revenue and EBITDA down there in the bottom right for our subject company. So very briefly, the company had been bought for a 3/4 of a turn on revenue and about 9 1/4 turns on EBITDA. So we know, valuation indications can't be drastically different than that unless there's, valid facts and circumstances that are documented to show that. So in this case, we've chosen a 1 and 10x for revenue and EBITDA multiples respectively, which does corroborate well to our data set. So again, I won't spend too much time on this slide, just in the interest of time, but just know that calibration is a key concept that's coming up here.
But this is your way, Russ, of kind of calibrating and looking at the chart from that table, your way of calibrating the actual transaction to comparable transactions. So it's a way of looking at the market both for the company itself and for other comparable companies that we found.
Yep, exactly. You can almost think about that transaction that happened in the company as a very strong indication of value, notably right after the acquisition. But as Richey May knows, when you move past that date, I'd call a year past the acquisition, that really, in our minds, a year is kind of the mark for it's time to start looking at the facts and circumstances to mark that investment to market.
I definitely agree.
And just very briefly, the second market-based approach that is very important to consider is transactions in a subject security or securities within the cap table. So in our case, if we had a common stock transaction and we were valuing the preferred stock, that would be a very important data set or data point to take into account when valuing that preferred stock, because it is an indication of value, and it's very important to document, again, to repeat that word over and over again, the methodology used to arrive at the preferred stock value based on the common transaction price. And you'll note here we just didn't use this methodology because there is no transaction since the acquisition date. And then briefly, we wanted to hit on the income approach. As Lindsay had mentioned, this really falls into the category of a discounted cash flow analysis in most cases, or in some cases a capitalization of earnings. And there's several key inputs here, and it does involve a lot more subjectivity, whether it be in the discount rate, the exit multiple or exit capitalization factor used, and the several other factors such as tax rates, NOL, potential NOL savings that could be brought into the future. And these are all key considerations Intrinsic looks at under the DCF approach. And we have provided just briefly an example here of a DCF approach. You're looking at free cash flow into the future, bringing that cash flow stream to present value, and then capitalizing a terminal value at a point where the cash flows have normalized in the terminal period. Whichever period is selected for the exit needs to be, a period where cash flows are normalized. And you'll see here, without getting into too much detail, I would like to hit on that C word again, the calibration point. As you'll see in the box, in the red box at the bottom, our DCF is calibrated, given the growth that has happened in the interim period since acquisition to those original prices paid. They do show appreciation, but just like our market approach, that's validated by the EBITDA margin expansion and some of the revenue growth we've seen since acquisition.
And maybe when you're on the topic of calibration, Russ, we could skip the next slide and just go to the total equity calculation to show, because there is a cost approach which is rarely used, but after we get to the poll question, we can just skip to that equity allocation slide.
Yep, as Josh mentioned, the cost approach, we had a slide here, but that's a method that sets the floor and is rarely used, at least in more of the companies we see in the healthcare and technology spaces.
And Travis had mentioned that in an audit process where the cost approach is used, that's something that would probably raise a red flag at first glance.
Yeah, if it goes out past a year, we're going to look at costs and why cost is still relevant.
Okay, yep, good.
And so we've got our third poll question here for you all. Thank you all for your responses and CPA credit there. So we had talked about bringing all these valuation approaches into one screen, as Josh mentioned, and this really highlights here on the slide the calibration, the triangulation on the right side is kind of visual for triangulation, and we're really showing all the approaches and how they all are corroborated on that central data point. And if there's any outliers, that would be a consideration for documentation as well. And we did choose to weight the market approach here most heavily, just given the recent transaction. It was 2 years ago, but the transaction we had in the company to calibrate, as well as a strong data set, whereas a DCF relies on much more subjective inputs. And we've seen some guidance from the SEC showing this, that they would prefer market approaches as a rule of thumb versus the income approach.
And the most reliable outcome, equity valuation outcome, is one where each indication of value falls within a fairly narrow range, and that goes back to your point of calibration. It means going back, revisiting some assumptions to ensure that each falls within that fairly narrow range, and that's a much more compelling case than to see some that are radical outliers. But so what I think is so cool here is last year we spent a lot of time on just the valuation approach. This year we had the benefit of Lindsay on board to talk about compliance issues. But then in addition to valuation, we're talking about a little bit more this year about distribution, about allocation among the waterfall or among the capital table. And so with valuation, again, we have these three different approaches. That's step one, is getting through these three different approaches. And then with allocating through the waterfall, the company's cap structure, we also have three different approaches, two of which we focused on to a certain degree last year, the OPM, the option pricing model, and the current value waterfall. And this year we're going to spend a little bit of time talking about the probability weighted expected return methodology, which is another way of allocating throughout the cap structure. But anyway, so thinking again, this is step two, which also has three possible approaches, all three of which could be used, but you might just focus on one of those. I mean, is that a fair statement, Russ?
Yeah.
Okay.
Yeah, I think this is an area that we see many challenges, probably even more so, from our client base in arriving at the security value as opposed to the total equity value, which I think everybody on the phone can kind of grasp that concept. And real quick, we wanted to focus on one area in particular, and it's this probability weighted expected return model. In our case, we had thrown up this current value waterfall. As you can read these slides later, but it doesn't apply in this case since we have some path dependencies with the accrued interest being built through time in our preferred securities, as well as this early exit provision. So in the current day, that, for instance, that provision would be triggered. However, it might not be the case in a reasonable holding period, since there isn't a buyer, at the door at this time that we've at least shown in this hypothetical.
It fails to capture the intrinsic value of those securities, right? Or the time value.
Yeah, the time value, exactly. So really the current value waterfall and would be capturing that intrinsic value, whereas you need to capture the time value and the holding period associated with the security. And again, we have this example here, but we really wanted to kind of present to everybody this probability weighted expected return model. And this looks at actually, it's a forward-looking approach that looks at multiple cases, business cases, as well as liquidity cases for the subject company. And what this boils down to is looking at a current value waterfall in the future and seeing what that distribution looks like, bringing back the securities to the present value, and repeating it across the relevant business cases. This does involve a lot of assumption in regard to those cases, whether it be an IPO, a sale, bankruptcy, or there can be a certain status quo scenario as well that we apply in some cases. But again, this is probably the more relevant in our case, just because we have a lot of those path dependencies in this preferred stock that are not handled well under a current value waterfall. And
it's sort of the most comprehensive look, right? So we've got the option pricing model, which would apply an option value to each of those securities, notwithstanding the fact that they might be underwater. There may not be value attributed to them just yet, not under the current value waterfall approach. And then with the probability weighted expected return methodology, we've got these scenarios that are most likely, the most likely scenarios that could take place in the future. We play those out as if they had taken place with the expected time frame, and then discount each, and then distribute those using a current value approach across the cap table, and then discount those securities back to present value. So as good as it sounds, and it's called a real options analysis, in other words, we're evaluating the companies or the assets' real options in terms of liquidity, there are a ton of assumptions that play into it. So on the one hand, it's much more comprehensive, and on the other hand, just as is often the case, it requires more analysis. It also involves more assumptions.
Yep, exactly. You'll see that here. We've laid out a quick example for our subject company showing a few different paths to exit, whether it be an IPO in 2018, which, as you'll see if you read this into the slide more, does trigger the early exit provision, whereas management has laid out a case for intermediate term sale and a later sale, which have their own respective current value waterfalls being applied. And of course, in those later scenarios, that provision on the early exit does not apply. But you are accurately capturing the amount of accrued interest on those preferred securities as you work through later exit dates. And again, this is just this slide has a lot going on, but I think it does highlight as Josh mentioned, the amount of assumptions that go in. However, it is theoretically a stronger approach than the current value waterfall in our case.
And again, going back to the points that have been raised several times in the conversation is the need for discretion and the need for independence and the need for having real candid conversations with management insofar as it's a matter in this case of evaluating these various scenarios. And these scenarios happen to be IPO, early sale, or late sale. It's limited usually to 3 or 4 scenarios because at the end of the day, we have to weight them. And you can see in the lower row there toward the bottom, we've weighted each at 60, 25, and 15%. Each of these scenarios is taking place, and then we've roughly gotten the dates that we anticipate them to take place in. But it obviously requires on both levels, both at the valuation of equity level and at the distribution among the cap table level, to have these very candid conversations with management to see what is most likely to occur.
Yep. And so, yeah, I think just to wrap up here on the valuation side, we have really 2 steps here, and the first being getting to total equity value, and the second to arrive at your security value. And that's really where some time should be spent in thinking through unique securities and the implications of their terms and conditions on their value. And that's what Intrinsic really spends a lot of our time doing. So with that, I think we've kind of reached the end of our time here.
We've managed to accomplish the goal of leaving no time for questions. But anyway, if you have any questions, by all means, please ask them, and we would be delighted to respond to any questions that you send us via email if we can't capture them in the few minutes that we have left here.
Absolutely. So please submit those questions if you do have those. Again, we will be following up with those via email. If you don't get a chance to type that into the question tab on the dashboard, please do email that out to us and we'll follow up. Just a couple other reminders. If you did answer all 3 poll questions and therefore qualify for CPE, we will be getting those certificates of completion out to you in the next few days. So please look for those via email. We will also be sending a recording of today's webinar and as well as a copy of the slide deck to all the participants today. So again, thank you for attending and follow up with those questions. Appreciate your time.
And a special thanks to Richey May for hosting us and putting this on, and to Lindsay Simon for putting together a great presentation for us.
Thanks, everyone.
Thanks all. Thanks.
Yeah.